there's a lot we could talk about. I'm going to talk about the developing world and the strategies and policies that sustain high growth, but I want to spend a little time on the financial crisis and also on some other things that we call global trends and challenges, which are potentially fairly major changes in the global environment and the way the global economy works. So just to start out, I think it's natural to ask if one is interested in the developing countries. This is a collection of about 150, 60 countries that account for approximately 5.5 of the 6.5 billion people in the world, and a number of them have been doing very well, and in particular a lot of people live in very optimistic environments. And so the question is, you know, will this pattern of sustained high growth that we've started to see, you know, work in the future? And the answer, I think, is basically yes, assuming that we are not at an inflection point in the way the global economy functions. But in the short term, there's fairly significant headwinds, and I've listed some of them here. And these are big enough, and I'm going to talk about them in a minute. These are big enough so that the more fragile countries in terms of the consensus that underpins the policies that sustain the growth may break down. So it's actually quite a worrying time from this point of view. And it's also very true that in the developing world, the confidence in the stability of the global economy has been shaken fairly badly. I think they will change their policies and strategies in the direction of thinking more about risk mitigation and protection against risk. And there's a lot of questioning in the world about the balance of benefits and risks in the global economy. So these are the topics I want to talk about. The sustained high growth model, which means what the dynamics that are actually working, and then a bit about the financial crisis. And I suspect we'll run out of time, but I will say something about global warming as one of the trends. This is just arithmetic. But on balance, these countries, the high growth countries, are growing. In particular, China and India are growing at about 6.5% above the advanced country sort of stable rate of 2.5 to 3%. And if they keep it up, then on the order of 25 years or so, in terms of sheer size, this is not per capita at all. They'll still be quite poor relative to OECD standards. But you can see that China and India together are not that far away in high growth mode from being a pretty big mass, and China in particular. India is about 13 years behind China. This is the Growth Commission, so I'll say a word about that. We put this together. These are dominantly people who are political and policy leaders in developing countries. So what they bring to, they're pretty knowledgeable economists as well in an applied sense, but what they bring to the party is the experience both on the political and policy side as well as the economic side of trying to get this done. This is very hard to do, to grow on a sustained basis at very high rates. And then we tried to put these people's experience together with a lot of good academic and policy research. We actually had 300 of our colleagues come to 20 days of workshops, and then we tried to put all that together and ask, what do we know now? What have we learned in the last 15 years about sustained high growth? So partly as a way of sort of explaining to practitioners what the sort of dynamics were, we actually went and looked at the countries that have grown at high speed, 7% or above for 25 years or more, sometime in the post-war period. Now that's a non-statement because you can't grow that fast historically. I mean, the UK grew at 1 to 2%, the United States at 2 to 3, and that was considered breathtakingly fast. But with the global economy and the inbound transfer of knowledge, you can grow at these rates now, and the open global economy. These are the countries. They're rather heterogeneous with respect to size, location, form of governance, democracies, dominant single-party systems, single-party autocratic systems, and so on. India and Vietnam have all the structural characteristics that suggest they will join this party. Again, always with the caveat that we don't have a giant disruption now that lasts. And there's a quite widespread pattern of accelerating growth in the developing world that goes beyond that. But I would say on that much wider basis, the jury is sort of out. The reason this is sort of, global economy changing is that the two big countries, China and India, account for 40% of the world's population, just all by themselves. So I want to say a word about what, I apologize in advance, this is overly simple, but we don't have that much time. But this is really what the report is about, is how do the dynamics work and what do various entities, especially governments, do to create an environment in which this is likely. So these are market economies, and the proximate driving force, as will not surprise you, is always the private sector. It's investment, innovation, and entrepreneurship. But it doesn't occur everywhere for a variety of reasons. So this is the economic side. I think by far the most important characteristic of the high-growth economies is that they exploit the global economy in two senses. One is demand, the sheer size of the market. And the way to think about that is a poor economy trying to build its growth on its own demand is building growth on very small demand and relatively uninteresting. And if it finds an area where what economists call comparative advantage, it'll run out of market very quickly. So, I mean, this has been known in economics for years. It's described as specialization is limited by the extent of the market. The global economy is so big, there are essentially no limits. But even more important than that is something that Paul Romer talks about all the time, quite rightly, and that is that you don't have to invent the knowledge and technology that enables you to do these things. It's imported. And a characteristic of a high-speed learning, of a growing economy, is it's also learning very fast. And we don't know enough about this. We know it's true, and we know some of the channels, like foreign direct investment, foreign education, things like that. But if a senior policy person in a developing country said to me, well, okay, I get that part. Now, what is it exactly we do to make sure that this is occurring at the highest possible rate? We don't give very good answers to that question. There's lots and lots of areas in which there's room for good, practical, sort of policy-oriented research. These are very high investment environments. This will, again, not surprise you. And what that means is 25% or more of GDP is being invested and usually saved. There is not a pattern of financing this with foreign funds in the high-growth cases. And when a country tries to do that, frequently something goes wrong. But we don't have very good theories of it. We just know empirically that there's disruptions. And the public sector investment, which you can think of as infrastructure and education and a few other little things, is also high, on the order of 5 to 7% of GDP. It's very easy to say. This is very hard to do. In a poor country, if your per capita income is $400, then you're not spending 100 of those dollars on average that are going into investment so that your children and grandchildren will be better off than you are. That's what it means on sort of the ground. I would say if you divide the explanations of the non-growing countries, and there are a lot of them, into economics and politics, and probably politics is more important than economics, but on the economic side, the single most powerful part of the explanation for the non-growth would be underinvestment, both on the public and private sector side. These are market economies operating with not only the usual static market incentives, but they are chaotic. I describe these economies as structurally transforming themselves. So if you look at them from a macroeconomic point of view at 30,000 feet, it looks like the water's rising in the bathtub. If you look at them on the ground, or at the microeconomic level, things are being created, things are being destroyed, industries are coming and going. And the transitions are really interesting. I mean, China, just to take an example, is not only confronting the same thing everybody else is, which is a global slowdown or recession or whatever you want to call it, but it's in the midst of an important structural transformation. Many parts of China are pricing themselves out of the growth drivers that carried them for the first 25 or so years. And it's very difficult to let go politically of the growth drivers. I was in Korea when they were letting go, and it was no longer possible to be the high-quality, low-cost manufacturing location. What governments do to enable this is two things. They make investments and allow the mobility to occur. Urbanization would be the most important part. Modern economic activity, notwithstanding the internet, is a body contact sport, to use Jim Gibbons' phrase, and it's conducted in an urban setting. And the other thing they do is get out of the way. And finally, they protect people. People don't like this process very much, and they need some form of protection in the transitions that they're being asked by the market system to undertake. And finally, because it's driven by investment, a certain amount of excessive risk introduced by incompetence or policy mistakes at the macroeconomic level or shocks from the global economy will slow this down. I think the biggest surprise for me is when I started out on this with my colleagues on the Commission, I thought this was mainly about economics. I was wrong. This is a lot about politics and political economy and motivation and incentives, and leadership really matters. Leadership matters in part because the institutions that you associate with a modern advanced economy that in some sense protect the economy against incompetence, you know, by having redundancy and expertise and so on, they don't exist. So the point I want to make is that you can think of growth and development as partly the things we measure, you know, per capita incomes, investment, infrastructure, you know, new cities, buildings, and all that. Even education, sort of soft, intangible assets. But there's another process, and it's what development really refers to, which is the maturing of an economy. It's the process by which it learns how to do things. To take a trivial example, in a developing country, it's probably true in most of the cities that they do not know how to manage traffic in the city. The system doesn't exist. And it's obvious when you go visit them. So this category of things is terribly important, and it's also frustrating, because if it's missing, it isn't obvious what there is to be done about it. I often get asked the question, what are we going to do about it, when we're talking about a class of countries that have dysfunctional political processes, including democracies. I mean, many African countries are formerly democracies that fail because of distorted incentives. By the way, there's really excellent work being done in political economy by Darren Asamoah and another a group of people that is not very far along yet, but is, I think, going to be the basis for understanding both the pathologies and the driving forces on this side. The other thing that is important to say is these are very long time horizon processes. These are, again, just arithmetic, but if at the highest known growth rates, it takes well over half a century to go from poor to OECD-like income levels. And if you slow down, then you dramatically increase those numbers. So the high growth is very important from the point of view of getting the job done and reducing poverty, but it's also, it tells you something about what's required. Persistence has a very high value, just staying at it, as opposed to being brilliant and getting one thing right. Growth spurts don't do anything for you. Growth spurts followed by, you know, running into the wall or tripping. There's lots of examples of it. You can just go look at the data. They don't help. But this, and one of the things that democratic country leaders do well is find a way to have long time horizons when the political system suggests they should be shorter. And I think that's an area where we need to do some more research as well. There are a few other key ingredients. I'm just going to spend a couple of minutes on them. If the commissioners were here in the room, with no exceptions, they would tell you that the top item on that list is crucial. That is, you don't pay attention to equity, equality of opportunity, and generally making sure everybody's in the game because it's a nice add-on. You do it because it's an inherently important part of the strategy. And if you don't, something will go wrong. It's usually on the political economy front. And there are really no counterexamples to that. The second is you have to support this structural transformation. And competition is very frequently limited in developing countries. You protect domestic industries. There are special interests that have political power. I mean, there's all kinds of things that go wrong. The hardest area is labor markets. It is almost universal, not quite. China's an exception, as usual, that you have a dual labor market structure in a developing economy. There's a formal sector which has higher wages and is surrounded by some legal structure. And then there's one or several informal sectors, usually urban and rural, and they're different. And what happens in many economies is that the formal sector has higher wages and the rest of the people are blocked out because the foreign business comes into the formal sector, does the economic rate of return calculations, and discovers they're not right and can't get to the pools of labor that they might be able to get at. Now, that's not the whole story. Sometimes the informal sector people are undereducated, and so that's part of the problem. So it's not, I don't mean to oversimplify this. The other thing that we talked about a bit about, so I'll just mention it, is the environment. The standard pattern in developing countries has been to view the environment as a luxury. That's the sort of thing that people in the United States and Europe pay attention to. And so we'll ignore that, and we'll grow now and deal with the environment later. It's incredibly expensive, except in the extreme short run. Because when you do that, you do almost everything wrong. You build the wrong buildings, the structural evolution of the economy is biased, and not to mention the direct effects. And the best single example of that, and this I was stunned by, is the pattern of subsidization of energy in the developing world is extraordinarily broad and deep. And so the Commission didn't often say something really blunt, but it did say, this is dreadful. These are very expensive policies. Those foregone government resources should be going into investments in human capital and infrastructure. And indeed, they're now so expensive that they're going away. The pattern is clearly, this is starting to decline. For those of you who are interested in what we don't agree on in economics and policy, there's a very large set. And now, the instinct on the part of some people was to say, well, there's a huge argument going on about almost all of these things. Capital controls, exchange rate management, whether or not the government does any good with industrial policies, and so on and so on. Why don't we just not talk about that? And we said, some of us said, well, you know, I mean, part of what people who are decision makers in business and government get to do is make decisions under uncertainty and incomplete information and debates. And this is no exception, so we shouldn't do that. So we waded into it. I can tell you that in a number of these areas, these commissioners, the people with a lot of experience, don't agree with each other. And so that might have caused a problem, but we just said, why don't we just say we don't agree, and then try to do our best to talk about the benefits and risks of taking various policy positions in this area. If we had more time, you could spend days on this, but I think the world is sort of changing in its perceptions of these things. We are not a decision maker in a developing country, the head of state or senior people, a finance minister. It either is going to let the global capital markets determine the value of the currency, or it's going to get managed somehow. There aren't any other options, and I think the direction we're going is to be somewhat more interventionist without being clueless about the risks. But we'll see. So the financial crisis. Where are we now? Well, I mean, I guess you've had many sessions on this, so this won't come as a surprise. There's a lot of damage that's been done. The financial sector has been, the process has actually already been transformed. And this number is out of date. The end of the year loss of equity value in the global economy was $27 trillion, with the starting point being 65. The major developing country markets are down 50% plus in the case of India, 65 in the case of China, and so on. These are, and part of this was undoing bubbles, so I'm not, you know, I don't want to come across as sort of saying they're just a result of chaos in the advanced country financial markets. But, and the rest of it I think is familiar to you. From a developing country point of view, there's a dividing line, and it's called September of 2008. Because up until that point, what the developing countries were dealing with primarily, it may surprise you to know, wasn't the financial problems that we were starting to develop. It was the price shock in commodities, oil and food. And that caused two problems for them. The food shock, it was enormous, by the way. I mean, over a 2-year period, the price of most of the grains doubled and tripled. This caused a global emergency among poor people. I underline global because we're talking about starvation here, or extreme malnutrition of the sort that permanently disables people's learning capabilities, of the type that Rick Hanachek and others talk about, who focus on education and its inputs. And the developing world wasn't prepared for this. And so the way they responded was to use the only weapons they had. Very few had conditional transfer mechanisms, either with respect to food or cash or anything else. So they imposed export controls. The two largest rice exporters in the world, India and Thailand, imposed export controls when this problem got bad, knowing full well that it wasn't the right answer, that it would muck up the supply response in the global economy because there weren't any other alternatives. This was serious, and it's what caused Bob Zoellick, the president of the World Bank, to sort of make it probably the leading priority through most of 2008. The other thing they had is inflation, and the reason's the same. In a poor country, the fraction of incomes, this is particularly true of poor people, going to food and energy is on the order of 50% for poor people, more in some cases. So if you double the prices of that thing, it's tantamount to knocking incomes down. And so when we had an inflation hit of 2%, they had 10. And so they were sitting there wrestling with, are we going to slow down growth and get inflation back under control and so on. And over the year, they also realized that global growth was going to slow, and so the exports would drop off. But on the whole, it looked manageable. They did not hold toxic assets. They had much stronger macroeconomic fundamentals in multiple dimensions as a result of thinking through and responding to the currency crises of 97, 98. And they had some asset bubbles that they were living through. And the channels by which the global economy was impacting them, that's implicit in what I just said, are just listed here. I thought I'd just mention them. But starting in September 2008, when our balance sheets got destroyed, more or less, and capital became scarce, it started to flow out of the developing countries. And so literally overnight, and they didn't expect this at all, literally overnight, they had a credit problem of enormous proportions. So that's the Indian rupee. Actually, it was appreciating. I should say one thing about these graphs. These are units of the currency per dollar. So when they rise, it's depreciating. Okay? So in the summer, and actually around the end of August, the rupee. What I'm going to show you is this happened everywhere. That's the Brazilian currency. That's the Russian ruble. That's the Turkish lira. And that's the South African rand. And I don't think most people in the advanced countries are aware of this. What this did basically is money started rushing out, and the effects were two. There was a credit problem domestically, and the exchange rate started to plunge, so to the extent there were dollar-denominated liabilities, they had that problem. That's one we know about from before. And it was extreme. I mean, it felt like a hurricane. And the response to that has been various. Some countries had built up reserves, and they reversed the outbound capital flows by essentially buying back their currency, taking the reserves out and putting them back in. That's not quite enough. Then you have to turn those, usually that's done with government bonds, and you have to actually turn it into credit for the business sector. The IMF has $250 billion to do this. It's not even close to enough to stabilize all these currencies. I mean, you need somewhere on the order of 1 to 2 trillion. And the only entity that has that is China. And the other thing that the Fed did, to their credit, is for a few countries, carefully selected, they created a dollar swap facility so that, in effect, they lent the money so it was like they had reserves. This is an important agenda item in the future. A global system that can respond more systematically and better to prevent the shock from spreading in this particular fashion. Now, does anybody want to guess what the one exception is? China. So China was appreciating slowly at their own pace up until the summer, and then they kind of took a look at this mess and decided that maybe they ought to stop that. With $2 trillion in reserves, they have complete control of this, and we don't actually know. China doesn't have a need for external financing. The savings rate recently has been on the order of 12% higher than the investment rate. I mean, as a fraction of GDP, which is a policy mistake of fairly large proportions. So it looks, by the way, this China's done before. I actually didn't find the graph, but if I showed you a graph of China's currency in 97, 98, and just following, when all the Asian currencies plunged, they went flat because we asked them to. If they depreciated to remain competitive into the currency crisis in 97, 98, there would have been chaos. At least everybody thought there would, and I think it's right. And they're doing the same thing again. Other people are depreciating and becoming more competitive, and they're going to try to hold their growth at about 8% without doing that. Now, whether they succeed or not, I don't know. So there's two ways to interpret that. They've stopped appreciating, but at least they're not going the other way. And they're quite capable of doing it with the control they have. Growth has plunged. The IMF forecasts that were released in October at the IMF World Bank meetings look, not very nice. They've been revised downward substantially. So we now have month-by-month forecasts for the global economy that are really quite dreadful. And I actually don't think any of us knows where the bottom is. So these are the current IMF forecasts for a wide range of countries. I know it's hard to see, so if anybody wants to kind of actually look at it. The yellow are 2009. So they're obviously low because that's a full year of a mess, as opposed to, we think, as opposed to just part of a year. And those are the deviations. So this is business confidence indicators in the euro area, the United States, and the emerging economies. And it's looking pretty tough. These are the risk spreads on emerging country sovereign debt. That's the blue line. And then two categories of corporate bonds in the markets. I mean, you've seen this before, but we've gotten partly through the liquidity crunch, but not all the way. This is Paul McCulley's graph describing Minsky's, description of the cycle that we're in, where we build up. And I'd like to say a little bit about that. Part of it was global imbalances. So the United States was essentially spending on a combination of consumption and investment more than we produced, with the benefit of three things: leverage, a misperception of risk, and a willingness to run surpluses in a fairly large fraction of the developing world, especially Asia. This was referred to as global imbalances, and our international system was either not serious about it or didn't really want to do anything about it. But nobody really thought, no, excuse me, some people thought it would persist and other people didn't. As a result, China started, with modest surpluses for a while, started to run big surpluses. Japan ran surpluses, and the United States ran increasingly large deficits. And then the developing countries, in addition, started running up reserves. Now, that's not necessarily a bad thing from the point of view of what they're faced with now. But they were doing this for two reasons. One is to manage, is to insure themselves because they didn't trust the IMF anymore. And the second one was they were running surpluses and they were managing their exchange rate by holding it down. And then in the United States, we had a housing bubble. This is the Case-Shiller Index, one of the most commonly used. And it rose until 2006 and then turned down. Europe had, with a lag, actually worse housing bubble. So those who think that things are going to be pretty bad in Europe are probably right. And then we built a securitization industry with an astonishing amount of growth in various categories. This alphabet soup is, you know, asset-backed securities, collateralized commercial mortgage-backed securities, and so on. And some of them structured, some of them not. And my view, I may be wrong, is that this industry was very profitable, and they ran out of stuff to collateralize, so they created an industry to feed it. And that's part of where the incentives for the poor origination performance on the housing sector side. And then, because those mortgages start to reset, and because the Fed was increasing interest rates, and the ECB was not, you know, it was keeping them relatively high, the non-performing assets started to kick in, and we turned over and got into the trouble that we're in. This is the leverage. So the American banks were pretty highly levered. The European banks are much more highly levered. And then the investment banks and brokers are kind of getting up there. Now, there's a lot of parts of so when this is all over, there's going to be a process both domestically in many, many countries and also globally of trying to figure out whether we can do a better job of this. And there are going to be lots of components of that. I personally think we need a very systematic, thoughtful process that involves experienced people from both the research side and the practitioner side to do this. And we haven't set up that mechanism yet. It'll involve incentives. It'll involve fragmented or incomplete regulation. We do have a shadow banking system. It is not regulated very much. But in my view, the center of this story is risk. And the reason I say that is because this is not a story where the sophisticated players pass the securities off to the unsophisticated ones. We wouldn't have had every major financial institution with a damaged balance sheet if that were the story. This is a story in which everybody, the regulators and all the major market participants with a few exceptions, misunderstood the rise in systemic risk. And I don't think we know how to model that right now. In fact, I'll go further. I don't think if Gordon Brown called for a global early warning system. Now, the rock bottom basis for a global early warning system would be a widely accepted measure of systemic risk. Now, we all know what we're talking about when we talk about systemic risk. But my claim is we don't measure it. Potter Stewart once said, we all know what pornography is, but it's very hard to define. And this is sort of the same thing. We really don't have convincing measures that would be the basis for intervention. My version of this is the risk models were, this is an exaggeration, were largely based on the assumptions that risks were sort of exogenous, mostly stationary, meaning not changing over time, and uncorrelated enough for the insurance and diversification models to work. And my guess is if you go back far enough in time, that was true. And that what happened is that the risks were in fact endogenous. They changed over time, and the correlations rose, but the market system didn't throw out any data that told you the original model was wrong until it broke. That's the challenge, is you don't get immediate feedback from the market. And so that's kind of on the agenda. I'm going to skip over some stuff. This is stuff that's familiar to you. LIBOR is back down to about twice what it's supposed to be, but it was up around 4, the spread, up around 4.5. These are the write-offs as of mid-October. They're larger now. The estimates are that we'll need $1 to $2 trillion to kind of recapitalize the financial sector from people like Ken Rogoff and others. That may be too low. One of the hallmarks of what's going on now is there isn't any private capital flowing, as far as I can see, into the financial system. And this is, I mean, we won't get past this until that gets reversed. There was capital flowing in. TPG had a big investment in Wash Mutual, wasn't it? And a lot of the sovereign wealth funds came in. So this is just a snapshot of their returns as of a particular date. Now, they may do very well. You know, the folks who invested in Citigroup at 60 and, you know, found it at 3 may find that over time, you know, it gets back. So I don't want to overstate this, but these are the returns as of a snapshot in about the start of November, minus 26% to minus 56%. And they're not going to come back until this sort of stabilizes, and lots of other people in general in the markets, not just in the financial sector, are sitting on the sidelines. So we have a kind of global asset deflation. And so the last thing I'll say about this is the thing that I think in the emergency response that we've done well and badly is the following. The response to the potential credit lockup was quick and very effective, very unconventional. I mean, buying commercial paper and whatnot. It's not back to normal because they're still having to do it. And the need for a fiscal stimulus, although there's debate about whether Keynesianism is really right or not, seems to me broadly accepted. What got lost, what was originally in TARP, and we stopped doing it. In fact, the Secretary of the Treasury said, actually, we're not going to do that. In the middle of this was buying assets. Now, this is a coordination problem. Right? If I told you, had the power to tell you that tomorrow everybody was going to start investing, we'd all start investing and do quite well. But in the meantime, we might as well let it bottom out and turn up a bit. But if we, in the aggregate, do that, we will overshoot. And this is a balance sheet recession. All right? This is a recession that started with damage to balance sheets. Financial institutions, households, now spreading almost everywhere. And then it fed over to the real side through loss of pension funds, reduced consumption, lost employment, reduced investment, and cycled in that side. But then it comes back because the present value of the earnings flow is lower, and so the assets are actually worth, and the whole thing's endogenous. And the problem here is, this is the psychological part, or the part that has to do with expectations, is to break the cycle. And we don't do very well in thinking about that yet in sort of economics, but it's a part of the equation. I'm going to skip over some stuff. But let me return quickly as I sort of finish off to two sets of things. One, how are these folks out there going to do in this mess? I think China is clearly likely to weather the storm well, in spite of the fact that they're in this structural transition. They have a GDP of 3.5 trillion, so it's a big domestic market. They made the policy mistake and are saving more than they're investing, so if they can get the savings rate down, they can get a big stimulus to the economy without requiring any external funding. All they got to do is stop lending us money at 2% or whatever it is now. They have huge reserves, so they will not lose control of their currency, and they can inject liquidity if they need to, though that doesn't seem very likely. They have $500 billion in sovereign wealth funds. They have very little foreign debt and a very low budget, a budget surplus. So their plan is to inject a massive stimulus into the economy. And they've done this before, too. That is how they handled the 97-98 issue. The betting odds among the most knowledgeable analysts is that China can hold growth in the 7 to 8% range. Some are more optimistic. They say 8 to 8.5. And that's down from 11, and you might say, well, so what? 8's pretty good. Well, 8 is actually viewed as kind of the danger zone in China because the expectations are very high and because there's over half the population waiting to move into the modern economy, and this will be felt as a real problem. India is much more fragile. So the challenge for India would be to hold growth in the 6 to 7% range. It was 9% in 2007. The reason India is more fragile is they run a very large government budget deficit. And so they don't have a lot of flexibility without putting themselves in kind of fiscal stress to stimulate the economy directly. And secondly, they're very dependent on foreign capital, particularly to fund public sector investment. As you probably know, one of the big investment opportunities around has been taking the private side of the public-private partnerships in Indian infrastructure investment, and that investment's crucial for the growth. So for a variety of reasons, I would like you to think of India as more typical of a developing country and more fragile and less capable. And I think over time, what's going to happen is as countries rethink their way of interacting, their fiscal policies and their way of interacting with the global economy, they're going to do things that we would call costly in a first best world in order to protect themselves in times of turbulence like this. That's a forecast. But you can start to hear it start to come out. Let me close by just saying, in the report, we knew the global economy was changing. You can't add, 3.5 to 4 billion people over time to the sort of group that's on track to become like us and not expect big changes. And so we tried to talk about those. And the last question that I'm often asked is, if you wrote the report in October, what would you do differently? And the answer is, I would make this section a lot longer. So I don't think we got it wrong. And I think what we're in fact going to do is try to have a bit of an addendum on the financial crisis. But these are challenges that I think need to be addressed over time. And if they're not, they have the potential to slow things down. There is a very widespread pattern of resistance to globalization in both advanced and developing countries. The exception, the lowest level, is in Asia, and that may change. This is based on, I think, two things. One is rising inequality of income and wealth, which is very widespread, in both developing and advanced countries, probably for different reasons. And the second one is a sense that it's too risky. It's just, we've lost control. We don't know how to govern it. And so these shocks are taking us over. That is going to require, that may produce protectionist pressure, and that would be fatal if it succeeds. Because the underlying basis of the developing country growth is the access to the global economy's resources. And so I don't think any of us are in the position of predicting this will happen, but there are benefits to paying attention to the distribution of benefits domestically in lots of economies that go well beyond the boundaries of those economies. You might call these externalities. And they need to be talked about as part of maintaining a global system. There is a view in the developing world that you can't compete with China. Paul Collier probably states it best. If you pay people nothing, the cost and efficiency and productivity advantage is so big in China that you actually won't be able to compete. Now, that's probably technically wrong for reasons John Chauvin will explain in a minute. It has to do with exchange rates. But what is probably true is that the social return to these, the question is, do the strategies work? And the answer may be the social return to the investments that underpin the strategies may be a bit lower in the future. There's no question, I think, that China has actually driven down, because of its scale, the relative price of a class of manufactured goods, and this graph kind of shows that. There are other adding up problems. Let me just mention them. There's a guy named Bill Klein, who's very well known, who in the 1980s wrote a very, very famous paper, which said, basically, the Asian tiger phenomenon is great, but if everybody adopts that growth strategy, it won't work. Bill wrote a paper in about 2006 and said, well, maybe I was wrong. Because in the intervening period, China had adopted essentially the same strategy, and somehow the global economy hadn't thrown up. Now, the way the global economy would reject the expansion of a set of strategies like that is through two channels. One of them is the relative prices turn against you because of the supply is so large relative to demand, and the other one is protectionism. And neither one of those, although there's risks of it, seem to have happened. So, and China, I'm now pretty optimistic about this, because China is in the process, at least in the coastal areas, of exiting into a different set of economic activities. India is expanding in the manufacturing sector, so the jury's sort of still out. No other developing country that's a potential candidate for the early stages of this strategy is big enough to cause it to fail. So if we can get through the next 10 years, roughly, maybe 15, it'll probably work. Commodity price volatility. It's serious. And I think it's inevitable. At these growth rates, we're going to run into bottlenecks and shortages just the way a developing country does. I mean, a fair amount of policy in China at 10 and 11% growth is running around eliminating bottlenecks. You know, there's not enough electricity. The harbor isn't big enough. There's 1,200 ships sitting outside, you know, in the ocean somewhere waiting to be unloaded and so on. This is, now that we have, it's not just high growth. Let me try to be precise about this. China, 25 years ago, was growing at 9%. But the economy was so small, it didn't matter. It's still growing at 9%. But it's $3.5 trillion of GDP. So when China grows at 10%, it's the equivalent of an incremental 2.5% growth in the United States. That's big. If our growth drops by 2.5%, that's a big number. That's what's going on. And India is, you know, somewhere around a third of that. So they're on at 10%. They're about 15 years behind. But that's the world that we're entering. Demographics, and then I'll tell you a bit about climate change. Most of the world is aging, including big developing countries like China. India, not clear. And people think this will slow global growth. So we really poked around in this, and the answer seemed to come back. It really depends on how we respond to aging. Bob Solow said, I said, well, working lives are going to have to change. You know, the institutions are going to have to change. You can't have pensions in Italy where everybody retires at 58 and lives to 95, although my fellow Italians don't seem to have noticed that yet. And Bob said, I don't want to work any longer. I mean, he's, of course, working, but he objected. The more serious problem is the reverse phenomenon. The poorest countries, the ones with the lowest growth, the ones Paul Collier talks about, have very high fertility. And a number of them have declining longevity because of HIV, AIDS, and other things, tuberculosis, and so on. And they have a group of young people coming out of education and onto the job market that's so large that even if they were growing at 10%, the highest known growth rates, they couldn't possibly absorb these people. And that's not really just an economic problem. That's a kind of global problem of disillusionment and security. And there's, if you're just logical about this, the way economists are, the global economy has mobile capital and mobile goods, and now mobile services, but not really mobile labor. And the only answer to this is to move surplus labor environments, move the labor to labor deficit environments. And that means retackling various forms of the migration issue. I'm not optimistic about this. People get very emotional about migration, and for good and understandable reasons, but we got a ticking time bomb on our hands. And it's true that if the pattern of growth spreads, it'll be better than if it doesn't, but it won't solve the problem. That's what I'm really trying to say. Finally, let me just say one word about George Shultz and I haven't had a chance to talk about climate change, but we've both been thinking about it. The developing countries are the climate change challenge over a 50-year time horizon. And the way to see it is just look at the per capita emissions. Now, the growth report is very clear. You cannot reach agreements, even in the long term, if you're not willing to do it on a per capita basis. And that's not the way the discussion is occurring now. But imagine a world in which we all had approximately the same incomes and we're having a debate about, about emissions. Would we say one country gets to have double the per capita emissions of another? Probably not. Seems like the right starting point. These are the per capita emissions in the world in tons in about 2006. So the world's at about 4.8. The Intergovernmental Panel says that we're safe at about 2.3, meaning we'll stabilize the stock in mid-century at something that doesn't eliminate the risks but makes them reasonable. The United States, Canada, and Australia are up about here at 20. Australia is actually at between 16 and 17. Most of Europe's in the 10 range, getting down to France at 6 because they have a lot of nuclear electricity. China's at the world average right now, which means they're a very big emitter. They're about a quarter of the United States, which means with 4 times the population, they've just sailed past us. By the way, most people think that China's extremely energy-intensive growth is about to reverse, partly by policy and partly because it's just going to happen. And there's no question that the energy and carbon intensity of advanced countries is lower than developing countries. That's clear in the data. The rest of the developing world, all of it, is below the safe level. But in the aggregate, there's a lot of people, so that's a lot of carbon. So if you looked at this, you might say, well, you know, we got to get the carbon emissions down by a factor of 2, and we'll be safe. Well, if that's true, if this remaining 4.5 billion people don't experience any growth, and along with it increased energy consumption, there's no way that a modern economy can be run on, right now, given existing technology, on 1 ton per person of output. Now, if you do the math and let these folks grow, particularly the big ones, and ask what's the problem if nothing else changes, they just end up looking like, not like us, just like Europe. And the answer is the problem by mid-century is on the order of 4 plus a bit times the safe level. So the challenge here is pretty big. And I don't think there's any doubt that it's going to require technology and the incentives that allow that technology to come into existence to solve the problem. But the remaining problem is we need the developing world to be engaged, but it's got to be fair. And so the challenge is to figure out how they can grow and still not blow the carbon budget for the world. This is a very hard problem. It's a hard problem to figure out what the time path should look like. It's a hard problem because we're operating with incomplete information. This is, if Howard Rafa was here, he would say this is, sequential decision-making under uncertainty with learning. And you do not solve one of those problems by picking targets for every country for 50 years from now. That's just not usually the answer to a dynamic programming problem. So this is, I think, may get sorted out. But I have to say the current state of the discussion of this is pretty far off anything that sounds realistic. And there's a similar set of things with respect to energy, except at least energy we pay for. It's not technically an externality. But there's a real question about whether energy is going to slow us down or whether we're going to adopt policies that allow us to build more and more growth globally on a limited natural resource base. That's probably enough for me.
Well, it's nice to see that Mike's working on some bite-sized problems. Thank you very much.